Swayam Prabha. Digital India. Educated India.
Hello and welcome. So, we have seen preparation of profit loss account and balance sheet from given data. So, you can have a look at the data that is given and that operational data and some balance sheet data for the year 2018-19 and balance sheet data as on 30/3/2019 are given. So, our job is to prepare the profit loss account and balance sheet and cash flow statements. So, we started by identifying revenue expenses first thing. We know the revenue, meaning the sales is regarded as revenue. There may be other income also, but sales is sales. So, we know that sales is 1,50,000 and out of sales and revenue are the only cash inflow. Majority are cash outflow. If you think of a company of your own, you will see that cash comes from very few sources, whereas cash goes from various stream. There are various streams of cash outflow, whereas cash inflow are very few. So, out of this data we have identified what are the revenue expenses that are revenue in nature. Out of that, purchase of goods is used to estimate the revenue expenses related to consumption of goods, which is nothing but cost of goods consumed in the context of a trading business. So, cost of goods is a revenue expense, purchase is not. You may purchase a lot of things, but you may not consume all of that. So, similarly, interest on bank loan is a revenue expense, but we want to separate them from other operating expenses, because operating expense does not include interest. So, we find operating profit, then we deduct interest on bank loan to receive profit before tax, on which we pay tax. So, this whole thing is about estimating first thing gross profit by estimating cost of goods sold. Then we deduct this from sales. So, 1,50,000 minus 83,800, we get 66,200 as gross profit. And as I mentioned, profit margin is always with respect to sales. So, gross profit margin is nothing but 66,200 divided by 1,50,000, which is the sales. Then we identify all other revenue expenses. Incidentally, depreciation and amortization are part of operational expenses. So, we estimate depreciation. Though I have mentioned about depreciation and we have defined it a little bit, maybe I will take another mini session to explain depreciation and to take a holistic view about financial statements in the next session. Now, after estimating depreciation, we have to add all the depreciations, depreciation on building, which is normally at 5%, depreciation on machinery depreciation rates vary across assets, like pollution control asset like computer normally is depreciated at 33%, 33.33%, meaning computers are depreciated in 3 years time, whereas machines normally on a ballpark we use 10% depreciation. Because we are taking a very simplistic example, we will not go into complexity about depreciation. Post depreciation, we get net value of a particular asset. Suppose you have building asset, now you allow depreciation during the year, whatever you get, that is the net asset that goes to the balance sheet. So, while you prepare depreciation and net amount of the asset, you keep on populating the balance sheet in the respective cells of the balance sheet. Like for building, our depreciation was 65. So, we deducted 65 out of 1300. So, we received 1235. So, we populated that in the balance sheet here. Building asset is here. Building earlier was 1000, now post depreciation the value is this, and this is the value as on 31/3/2019. And because this is the value that is showing in our books of accounts, this is also referred to as the book value. So, book value is nothing but procurement value of any asset minus all the accumulated depreciation during the used life of the asset. Suppose the asset was there for 5 years, accumulated depreciation during this 5 years is deducted from the procurement cost to get book value of the asset or the net asset value. Then we estimate the operational expenses. Here it is, and we pick up the sales from here, whatever we have identified, and you can see the formula, and all items have been covered including depreciation and amortization. So, we get operating profit. We deduct operating expenses from gross profit, we get operating profit, and in the same manner operating profit divided by sales is operating profit margin. Then we add other income. In this case there is no other income, or there is. Truck hiring charge is 300. So, we add that, so that or we subtract interest, because interest is not operating expense, operational expense, we deduct that, and then eventually we get profit before tax, and we charge or we pay income tax on this amount. So, income tax rate, if it is 30%, then we add 30%, deduct 30% of that as income tax, we get 8,836. This money belongs to the founders, owners of the business. So, owners, 8,836 is the money that belongs to the owner. Now, it is the prerogative of the owner to take away all the money or to decide to put back all the money back to the business for the growth of the business, either way, or they may take partially and keep the other part, so that for business growth they can meet the expenses necessary or capital investment necessary. And then net profit margin also is estimated in the same manner, net profit divided by sales. And after payment of dividend, dividend is the money that owners are taking away from out of the net profit. So, they are taking away only 1000 rupees. So, 8,836 minus 1000, this is the money that remains in the business. This is termed as retained profit or retained earning. Then this retained earning, this arrow should actually come down. This retained earning is transferred to balance sheet and added to reserves and surplus of the previous year to receive or to obtain the reserves and surplus position of the current year, that is as on 31/3/2019. And majority of the other items in balance sheets are already given, meaning that in a real situation you will receive that from your general ledger heads, the balance as on the end of the year. Cash balance will not be given, this should come from cash flow statements. I am just populating for example purpose. Total current asset will be estimated based on closing stock, which is already given, you get it from the general ledger. Total receivable, you get it from general ledger. So, all the data are already available, and if you estimate cash flow statement, whatever is the closing cash balance, add them and you get the total current asset. Total non-current asset also is given, everything is given. Land is never depreciated, so land comes just like that, and we have not procured any new land, neither we sold any old land. So, land remains as it is. Building value comes from calculation of depreciation. Post depreciation our building value was 1235. Similarly, plant valuation post depreciation of 17,028. So, that remains as it is. Then preliminary pre-operative expenses we have allowed or written off 200 out of the 500. So, what remains is only 300, 500 minus 200. So, we get the total non-current asset, this becomes the total of the asset side. Similarly, for liability side, majority of the items are already there, like payable amount is already there, accounts payable or trade payable, but short term loan, bank loan is to be obtained from the bank. So, bank will tell you that this is the outstanding balance in your short term loan account, that is your subtotal. Long term loan, you have to see your earlier loan was 5,600, then you have repaid 1,600. So, deduct 1600 from 5600. So, you receive only 4000, that is the outstanding, but then you have raised another 9000 new loans. So, 9000 plus 4000 becomes 13,000, that is how you get this amount. Paid off capital was 7500, now you added 1000 more during the year, new capital was inducted by the founders, that becomes 8500. Reserves and surplus, you know that retained earning is added to the previous year's reserves and surplus and you get 20,000. So, you get the entire balance sheet populated, and that is all that about balance sheet. Let us see how cash flow statement is prepared. We will take a short format of the cash flow statement. There is a direct method and an indirect method of estimating cash flow statement. The direct method uses all the transactions, meaning whatever transaction that a company does in a year, it takes into account all the transaction. So, all the sales, all the purchases are taken into account to estimate profit, and then gradually we move forward. Whereas, indirect method actually starts from net profit. They do away with the sale, purchase, etc., but they start only with net profit. Just follow the format, it is normally an accepted format across the world. So, I am not going into the format, I will just show you how this, what is the format and how we use that. As I said, there are three activities from which cash flow happens. One is the cash flow from operating activity, is just a classification, there is no hard and fast, but then it makes it simple and it makes the information more meaningful. If you submit your financial statements to a banker, they would like to see what is the cash flow from operating activities, what is the cash flow from investment activities, what is the cash flow from financing activities. If you show that you are cash positive, they would like to see whether you have borrowed money from a sister concern or some external agencies without the knowledge of the bank, with the knowledge of the bank, and if that is positive, that does not really indicate a healthy situation. Whereas, if you make a huge positive cash flow like this one is a 11,750 positive cash flow from operating activities, this actually shows that you are better off compared to had it been a negative net cash flow from your operating activity. So, that gives comfort to the bankers in the sense that they think your business is doing good. Otherwise, suppose you have a positive cash flow in the form of, suppose you borrow huge money, or maybe your creditors go up and etc. That may not indicate that not creditors, eliminate creditors from the statement. Suppose you borrow money from bank, borrow money from friends, relatives, or induct money, unsecured loan into the business, and you show huge positive cash flow, that does not indicate a good health. So, bankers would like to see where from cash has come and how you have used the cash. Suppose you received lot of good cash, meaning positive cash flow was there, but then you use the cash to give loans to founders. That is again is a bad omen. Bankers hate that part. They are suspicious that founders or owners are taking away cash from the company. That shows that they are trying to run away from the business. So, they will have a deeper look into your operating statement, whether you are really making profit or you are cooking up the books to just show a profit, so that bankers will not call back the money. Okay, let us move forward. For operating activities, there are items like net profit is the first item. Whatever net profit that you have estimated in the profit loss account, it just comes from here. I have just picked up the data from the formula, using the formula. So, this is 8,836, you may remember, but it is before paying dividend. This is not retained profit, this is net profit. Then one thing is depreciation and amortization. Depreciation is a non-cash expense. You bought machinery, you have invested money in that. Now, you are not making any payment to an outsider, you are just allowing part of the investment that you have made to procure fixed asset and allowing that as expense, meaning that you are recovering the cost of buying the fixed asset over the life of the fixed asset, because this is an investment and you all the sources from where you can recover any expenses is through sales. So, you have to deduct these expenses from sales to estimate profit, and any government allows depreciation to be deducted as an expense. So, eventually you end up making less tax payment. So, your income tax goes down because you are deducting depreciation from total income, and then depreciation is you are showing as an income. So, it is going away from the profit. Now, it is going away from the profit in the books, but your money remains with you. That is why it is a positive cash flow from cash flow point of view, because you have deducted that from profit. If you would not have deducted from that, your net profit would have gone up. So, from that point of view, depreciation is a positive cash flow. Now, look at the next 3 items carefully. These are very important. The convention is very important. Change in inventory and stock, inventory or stock. These are not really cash, but they are like cash, cash equivalent. So, suppose your inventory goes up, say last year your inventory, suppose hypothetically speaking, was 10,000. As at the close of business of this year, suppose the inventory is 15,000. So, during the year your inventory has gone up by 5,000, where from you procure that inventory. You have procured that inventory by making payment to suppliers. So, some of the money has gone in the form of inventory, that is 5,000 rupees worth of cash has gone in inventory. So, this is a cash utilization. You may argue that this may be a stock purchase on credit. So, that will come again on change in accounts payable. So, these are explicitly taken care of. So, do not mix this credit purchase or cash purchase or anything. If inventory goes up, you presume that money has been utilized for this purpose. So, this cash flow is a negative cash flow. If inventory goes down, suppose last year inventory was 10,000, this year inventory is 8,000, that means inventory has gone down. So, when inventory goes down, some money is released, because now total money blocked in inventory is only 8,000, whereas total money blocked in inventory as at the close of business in the last year was 10,000. So, there is a decrease. So, this 2,000, the difference between the inventory will be regarded as positive cash flow. That is the convention, and you should understand it that way. Do not try to remember formulas, it is very logical, and just remember that. Change in accounts receivable. Accounts receivable, as I said, arises when you sell some goods and the party is yet to make payment. So, because you made some sales and party is yet to make the payment, so whatever goods that you sent to the customer who bought this, definitely you spend some money for procuring goods to manufacture them, to pay salary to people, etc., etc. There are many expenses involved in making finished goods from raw material. So, whatever is the value that you have supplied, value of the goods that you have supplied to somebody, money has been utilized to make them. Now, do not worry about individual transaction, but think of the position as at the end of the business in the last year and position as at the end of the business this year. If there is a difference between receivable, last year suppose receivable was 10,000, this year suppose receivable is 12,000, that means receivable has gone up by 2,000. So, definitely you spend 2,000 rupees to build this receivable. It may not be exactly 2,000, because there is an element of profit in that. Forget about all those small things. Just presume that by whatever value the receivable has gone up, this is a utilization of cash. So, that should be regarded as cash outflow. On the contrary, if receivable goes down, that means suppose last year receivable was 10,000, this year suppose receivable is 7,000. So, your money that was due with the buyers dealers, distributor or customer, that was 10,000. Whereas, as at the close of business this year, the receivable has gone down to 7,000. That means, you have recovered some additional 3,000 rupees over the year, over the period of the year. So, money has come in. So, that means, if there is a reduction in receivable, there is a positive cash flow by that amount. Similarly, payable convention is just the opposite, meaning that if your receivable goes, if your payable goes up, that means somebody has supplied you more goods. Payable going up means somebody has supplied you more goods compared to what was the position in the last year. That means, you have received some goods, but goods requires money. So, even if you receive some additional goods, it is regarded as if you have received money. Therefore, if payable goes up during this 2 point in time, one is the close of business last year, another is the close of business this year, then we regard that as a positive cash flow. If receivable goes down, if payable goes down, that means you have made some payment against the supplies that they made earlier. That is how the position has gone down. So, there is a negative cash flow to that extent, the extent by which payable has gone down. Therefore, we have to understand the change in inventory, change in accounts receivable, change in accounts payable, and that is why we have made this column here change. You can write it here, you can do it separately. So, we will not talk about cash, because forget about cash at this point of time, because we have not yet done the cash flow. So, eliminate that part from here. Now, as I said, closing stock, which is nothing but inventory, closing stock of raw material, finished goods, goods in process, everything together constitute inventory. So, inventory was 14,200 last year, this year it is 15,400. That means, this minus this, there is an increase of 1,200. If there is an increase of 12,000, that means, you have used some money to buy these additional goods. So, that means, 1,200 is the negative cash flow. That is why we have done this here, meaning that is equal to minus this. So, if this is an increase, automatically it will take minus. If there is a decrease, automatically there will be a plus sign. Change in accounts receivable, let us see, receivable is here, trade receivable was 9,100, here it is 8,100. That means, there is a reduction, this minus this, there is a reduction of receivable. Convention is same as a stock inventory. So, because there is a reduction, so there is a positive cash flow. Normally, we say, we write it here is equal to plus is equal to minus this item. Here also it is equal to minus, there also is equal to minus. So, if there is a negative sign here, automatically it becomes positive. Change of accounts payable convention is opposite. In this, it will be just equal to rather than minus sign. So, that if there is an increase, there will be a plus, if there is a decrease, there will be automatically a minus. So, here let us see what is the receivable here. See, the receivable here is 957. Receivable has gone up, that means, you have received some money equivalent of a stock equivalent of money 957. So, that becomes positive. So, subtotal is you have to total with sign. So, this is negative, this is positive, this is positive, this is positive. Total becomes 11,750 rupees of net cash flow out of operating activities. Now, let us do this for investment activities. Remember that investment activity means wherever you are investing money, do not confuse this with financing activity. Financing is wherever you are raising money from, investment activity is wherever you are putting money in. Maybe you can sell something also, that also is contra investment, meaning that you are getting back the invested money. So, if some of your fixed deposit or some investment matures and you receive back the money, that also is investment, that is negative investment. So, that becomes positive cash flow. Now, look at change in land. Have you made any investment in land during the year? Look at the land position, it was 500 last year, 500 this year, there is no change. So, change in land is 0. So, there is no cash flow out of land. Change in building, you have to see whether you have created any new building or you have sold some new building. Do not look at this data, do not look at this data, because this data is post depreciation. It does not indicate the right value of the asset that you have procured. So, you have to really go back to this position, like purchase of truck, like construction of factory shed is the new building that you have constructed. So, if I talk about building, then you have to see whether you have constructed a new building during this year or not. We have actually invested 300 rupees to make a new factory shed, and because we have invested money, that is a negative cash flow. If we have sold this shed for 300, would have been a positive cash flow, meaning cash will come when you sell some land, some asset. Now, for machinery, the position was something, say 6,800, that was the position in the last year. We have to see whether we have invested, do not even look at this data. We have to see whether we have made any fresh investment in new asset or whether we have sold any new asset. If we have not done anything, then it will be simply 0, just as we have done in the case of land. Now, see machinery, we have to go back to this place and see machinery position. Purchase of equipment is another machinery, that is 12,000 rupees. Then construction of factory shed has been already considered in building, so it does not come. Purchase of truck is 2,500. So, 12,000 plus 2,500 is 14,500. Then purchase of telephone is 20 rupees, so another 20, 14,520. So, we have to see that way whether we have bought any other, we have to write all the purchase of the asset here. So, this is 14,520 is the value of the machinery that we bought during the year. Money has gone out, whether we bought it on credit or cash, do not worry about it. You have to consider that money has gone out. So, machinery is minus. We have to see whether we have sold any machine. Incidentally, we have sold some machine for 2,400, sale of machine with book value of 2,400. Because we sold it for 2,400, there is no capital gains. We will take another mini session on this, but for the time being, look at this, that the data was 2,400 and we have sold, book value was 2,400, we sold it for 2,400. So, there is no profit gain, but then when we sell the machine at whatever price, cash comes in. So, this is a positive cash flow. Now, we make an aggregate of the cash flow from investment activities. So, minus 300 minus 14,000 plus 2,400 makes minus 12,420. Let us see cash flow from financing activities. These are the activities from where cash comes in or cash you use to repay some of the similar kind of sources of cash. See, change of long term loan. Long term loan position was something. Here the convention is slightly different. You have to see now, see in case of building and all, we did not go to the balance sheet to know previous balance, but in case of loan you have to go to the balance sheet to know the previous balance. See, long term loan, long term liability, first thing is long term or short term, long term loan. So, we have to see long term loan. Long term loan earlier year it was 5,600. You have to see whether you have repaid any loan. If you remember, we have repaid 1,600 rupees of loan in the current year. So, you have to deduct that because the loan outstanding has gone down by 1,600 rupees. So, 5,600 minus 1,600 becomes 4,000. Then if you remember, we made fresh long term loan of 9,000 rupees, and therefore, this is to be added to that 4,000. So, that raising fresh loan of 9,000 rupees here, we raise fresh long term loan of 9,000 rupees. So, add that 9,000 rupees with the 4,000 rupees, the balance becomes 13,000 rupees. So, that is very important. Whereas, see, the convention for long term loan is different from the convention of short term loan. Short term loan, you have to make just a subtraction from this year's balance minus previous year's balance. You have to remember this convention, because there is no concept of repayment of short term loan. So, whatever is the balance as of closing business of this year minus the balance of previous year will become the cash flow. So, because the balance has gone up, that means we have received some money from the bank in terms of short term loan. So, whether if the loan goes up, we receive the money. Change in long term loan has gone up. So, it is a positive cash flow. Short term loan has gone up by 4,470. So, this is a positive cash flow. Change in equity, we told at the when we provided the data, we said that founders bring in new equity of 10,000, that means founders has brought in 1,000 rupees. So, we add that here, this is a positive cash flow, because money, even though founders are part of the company, they are external agent. Company is a separate entity. Company is called a juridical individual person, juridical person. That means company is from the point of view of the law, company is different from the founders. So, founders brings in money, that is a positive cash flow. Now, we pay dividend to founders. So, founders take away another 1,000 rupees. So, money goes out, that means cash goes out, that becomes a negative cash flow. So, we make a subtotal of this, and net cash flow from financing activity is plus 7870. Now, we add this to the net cash flow from investment activity and net cash flow from operating activity to receive a total of 7,200. That is the net cash flow during the year. So, our company had a net cash flow during the year is equal to 7,200. Now, we have to see what was the cash position in the previous year. That cash was always there with us. So, previous year the cash position was 1940. So, here we have to add that with this net cash flow from the year, add that with the previous year's cash flow to get the balance of cash position as at the close of business this year. So, here we populate this one by picking up data from this position, and then we get the cash position of the present year, that was 9,140. So, we make a total of the asset side, which becomes 51,773, and we see that liability side also is equal to 51,703. That means, asset side and liability side match together, means match exactly same. That means, the balance sheet has been balanced. That means, we have not committed any mistake in preparing the balance sheet. So, that is what is cash flow, balance sheet and profit loss account. This is we are drawing a conclusion here, and in the next session, a mini session, I will be talking about depreciation slightly at length, and if you sell an asset, say fixed asset, at a higher value or lower value compared to the book value, then how you treat that in cash flow statement, in profit loss account, we will show that. So, thank you very much for the time being.